Okay, so our next panel is discussing the conundrums of mining equity investment today. So I'm sure it's going to be a very positive, very, very positive panel, telling us how fantastically we've created value over the years, or not. Fiona.
Good morning. Can everybody hear? Yes. Thank you, Bernard. Yes, I'm sorry I threw in a big word, a big English word there, conundrums. You do know what a conundrum is,
No,
Bernard?
but I pronounced it correctly, did I?
Pronounce it, yes.
I thought it was a fuck up, but I don't know. I don't know what it means.
It's a confusing problem, a puzzle, a riddle, an enigma.
Exactly.
Yes. Okay, so you know, right.
Thank you.
And we've got a wonderful panel here, a broad church, as I would call it, starting with Adam Matthews, Church Commissioners, Tom Attenborough from the London Stock Exchange, George Cheveley, 91, Jim with 3 hats on. I don't know how you wear 3 hats, a bit like Tommy Cooper, but he's chair of Centamin, board of Ecora, and the board of Manara, and then Tal Lomnitzer from Janus Henderson. So it's a broad panel. It's also a broad range of topics, so it may sound like we're jumping around a little bit, but the conundrum of mining investing these days. I remember a fund manager reminds me that in the 1990s, when I was a sell-side analyst in the UK, I used to advise him how to be successful in mining investing. I used to say, buy Rio Tinto on a 4% yield and sell it on a 1% yield. That's how straightforward it was. And as we all know now, an infinitely more complex world, energy transition, longer lead times, geopolitical fracturing. So let's go into the first of the conundrums. There's lots of weeping and wailing about the fact that London used to be the center for mining finance of the world, and right back to De Beers. Now people are asking, not only in London, but generally, is the listed market in general the right vehicle for a sector, as we've heard from Rotesh, that is not liked, undervalued, and struggles to find capital? So let's start with Jim, who is actually chair of a listed junior miner. Jim?
This is a topic that gets a lot of discussion, as you can imagine. And for those who are not aware, I also worked on the initially sell side and also the buy side for a long time. So I've seen the argument from both sides. There's really 2 elements to what you're saying. One is London, and then the other is listed versus private. And I think there's a couple of things going on. First of all, I sat on the boards of companies that have been involved in Canada and in the UK, and certainly there are aspects of being listed in London where you would have to say there's a little bit of regulatory overkill. And from things such as the ability to raise financing quickly, the increasingly onerous responsibilities that are getting piled upon board members, especially on audit committees, where when you look at some of the proposals, you question whether there are enough hours in the day to actually fulfill those. And frankly, also I think some of the proposals start to veer into confusing the distinction between what is executive and what is non-executive. You're a non-executive director on a board, but some of the proposals you see coming through almost have hints of implying that people should be behaving in a more executive fashion. On the second point on listed versus private, I think there's a couple of things happening. One is this industry suffers from a real scale problem in the investment universe. We've also seen the disappearance of a lot of the specialist mining funds. To get on the radar screen of one of the major institutions, and George and Tal can talk about this more, the required minimum free float just gradually increases year by year. And now anything under $1 billion you're just not going to get the attention from one of the major institutions. There's another aspect to it, which is, I think, for the first time in my entire career, access to raw materials is now becoming an issue of national security. And that partly explains why you've seen the evolution of some sovereign wealth funds becoming involved in mining. Also, the whole debate around critical minerals, the US really finally waking up to what's happening. And I don't think that's a trend that's going to disappear. I think this is just, we're seeing the changing face of an industry.
So, thank you. Tom, the advocate of listing public markets, can you counter to that? Do you think the public markets are the right vehicle? And if they're not delivering at the moment, what plans are underway to help?
Yeah, look, I'd say a couple of things. To start with, I head the international listings business at London Stock Exchange. I've been there 10 years, and I think over the last 2 or 3 years, there's been quite a lot of sort of soul searching on, not just on the London market, but on what markets around the world are there for, and how they're preparing for the companies of tomorrow, not just the companies of yesterday. I think there's an awful lot of reform going on at the moment, which I'm sure people have read about, whether it's changing the listing rules to pick up Jim's point, to move to a much more disclosure-based regime, trying to take out some of the grit in the system, make it more straightforward for companies to list, both those that want to make London a primary home, but also I think in this sector particularly, where companies are listed elsewhere and want to have a secondary listing in London, but perhaps don't want to go through quite the same rigours as those that are going to be index constituents and primary listed in London. So those new rules will be out within the next month. The FCA has signed them off this week, and they should be published by the end of July, or mid-July, and enacted by the end of July. So I think that's a big step forward. But that's only one piece of it. There's a whole raft of other reforms that we're agitating for, whether it's a renewed look around sort of corporate governance and REM, which I think is an issue that's not often talked about, whether it's the sort of ineffable rise of the proxy agencies in some of these decisions, and how can you actually rebuild, through, I think, some work going on rewriting the stewardship code at the moment, rebuild the relationships between the people who actually own the assets and the companies themselves, rather than outsourcing everything to proxy agencies and compliance teams. I think that's an area of interest. And I think more fundamentally, and again, to what Jim raised, how do we get more capital back into the market full stop? And there's a couple of aspects to that. One is trying to enfranchise retail investors and make markets, why is it that you can be standing on a street corner with your mobile phone and with a couple of clicks buy crypto in a totally unregulated market, but struggle to participate in an IPO in a very regulated environment with a prospectus? That's nuts. And we're doing some things to try and improve that. So I think there's a lot of things that over the next sort of 12 months are going to come through, which will be a boost to market. But we're sort of middle of the way through that journey, and I think there's more to do. And if you look at the facts, as Jim said, it's been a de-equitization of the sector. We've still got 175 metals and mining companies on the London market. It's still about 15% of the world's market cap in the sector, so it's still significant. But it's quite concentrated in a few very big companies, and then 100 of those 175 are sub-$100 million market cap businesses. What's been hollowed out through a combination of forced delistings of Russian stocks, consolidation, is the mid-market, where if you look 15 years ago at companies between a sort of 200 million and 5 billion market cap, you had about 60 of them in London. We're now down to 20. And that's been a big change. And what we want to do is try and have an environment where some of those juniors that continue to come through can scale and become those businesses going forward and fill that middle ground. Because that flow is still going on. We've had 50 listings in London in the last 5 years in the mining sector. So, but they've all been, or many of them have been in that $20 to $100 million market cap, space, very much at the junior end, and it's about getting those to scale. I think that's our next big challenge.
Can I come back on
Yes.
something you said?
Yep.
So I don't know if this is working. Hi. Sorry, just to clarify, I'm not the Church Commissioners, I'm the Church of England Pensions Board. We're a totally separate pension fund, so just to clarify that. But we are invested in mining companies through debt and equity. The word you used on agitate and the stock exchange, you have been agitating, and I really don't disagree that there's some elements of reform that are required to enable companies to list, and there are other things that we can do to enable that process to be smoother, etc. But a lot of the agitating that is going on at the moment is for a watering down of some of the principles of good governance that I think makes London attractive, and particularly attractive to institutional investors. And I think there needs to be much greater caution at the agenda that you're agitating for, with a small select group of people that are going to sort of, their institutions are benefiting from a lot of that agitating. And I don't think the case has been proven for some of the agitation that you're pursuing at the moment. And I think the opportunity is to actually sort of sit down with institutional investors, in particular asset owners, and say, how is it we can change the dynamic that actually we run away from this sector rather than lean into it? And actually really look at the ways that we can work with the stock exchange, with our fund managers, but with the regulator and with companies, so that we can get much greater confidence in the way that we can intentionally be making London a home for listings, a home for raising capital, and a home for good governance and best practice and all the standards that Ro was talking about. My fear, this sort of predetermined perception that watering down is going to achieve what you think it is, hasn't been proven. And I think institutional investors, in particular pension funds, are deeply concerned at the agitation that's been going on. And I think the opportunity is to do the reverse and actually double down on how we can really work together much more constructively than I think we're currently looking to do. And I would hope that the stock exchange could play more of a constructive role in that. And I didn't hear the stock exchange voice when one of your former members on the exchange was about to eat one of the other members of the current stock exchange. And I think that there's much more opportunity for us to be looking at how do we really stand behind those companies that are trying to do the right thing, need to be able to have long-term capital and confidence, and institutional investors are going to walk with those boards as they respond to the global demand.
Yeah, right. Tel, I know you have a view on why companies should be listed and why asset managers should get fees for active fund managers should be.
Yeah, I think accountability is a big issue. And it comes back to some of what Ro was talking about. Look, I think there's lots of avenues for companies to finance themselves. It's a mosaic, privates, royalties, and the public markets all need to play a role, as well as debt markets. I think a big part of the problem that we're seeing in terms of the lack of interest in the middle market and the smaller cap market is simply because investors lost loads of money. At the end of the day, investors invest to make money. And we saw a wave of influx of companies during the China super cycle that led to overvaluations, perhaps some companies that shouldn't have listed, raising money. And at the end of the day, the response to that is a lack of interest today. Now, I think, and I echo the point that Adam made, that keeping these standards high can protect against that. And that's what we need to instill confidence, ensure that money stays coming into companies, and that we can perhaps revitalize the interest of the broader market, broader investors, and individual investors. And we've seen that happen in Australia. It's a pretty vibrant market at the moment. Unfortunately, we've seen London take quite a few steps backwards. Canada's sort of treading water. But there is hope, I think. But I think we do need to keep standards high and ensure the companies can be accountable. And transparency and accountability are going to be very helpful tools along that journey.
Yeah. Just so in the past, the Diversified mining company, the mining finance house, was actually also a source of new investments, bringing on the juniors that are now struggling to get the funding. Is the Diversified mining company model obsolete, the one that took the cash from the bulks and the cash generators and put it into new, perhaps riskier businesses? George?
I don't think it's obsolete. I think one of the problems, the theory of a diversified mining company where you know, one business is always making cash and that can fund businesses that need development and aren't making cash is very nice. Of course, in practice, you know, if you're running the iron ore division and you're making lots of money, you're not going to be sitting there going, let's give all that money to the copper division or something else. You're going to want to reinvest it, and you'll go to the board and say, look, my returns are better. Why don't we reinvest it here? So the pressure is always to, you know, back the winner, which is completely contrary to the theory of how a diversified miner. And we've seen many companies where, you know, the theory really is we always have cash flow to invest. You're always generating some positive cash flow, and you can do that by being diversified. You can also do it by being very low cost. So you don't have to be diversified to generate cash flow through the cycle. And if you can do that, then you have that ability to take advantage of weak points, etc. So I do think that the sort of old view that diversified, you know, works well from that movement of cash flows, that hasn't really proven correct.
Yeah.
As a fund manager, I think, you know, obviously we have an opportunity to do that ourselves. So we would say, you know, I can take profits on a copper company, invest that somewhere else. As an active manager, that's something I can do. I'm not saying that's all companies should become pure plays, but I think we're right. I think there's an issue of scale, which is a problem as projects get bigger. We see huge amounts of capex required. You know, what companies can actually, you know, take that risk on, and maybe we're increasingly seeing a sort of more joint venture approach.
Yeah.
Which probably has to happen.
Yeah. So two follow-ons from that. The other traditional view was that the diversifiers have lower cost of capital, and therefore they are the best investors in the sector. And yet they appear now to have risk-averse boards who, rather than invest in these big projects, are actually bidding for other diversifieds. So, Adam, you've been pretty vocal in your opposition to the BHP bid for Anglo. Can you give us some colour on why that was?
Yeah, happy to. I mean, obviously that's in the past, but I think our concern as a pension fund, and pension funds, unless they're sort of very significant shareholders in a company like, for example, the South African fund, aren't normally sort of speaking up on sort of acquisitions like this. So it was a bit of a unusual step for us to make an intervention in the way that we did, and we were joined by other pension funds in that concern. And it was based on the fact that, from our perspective as a long-term investor looking at multi-decadal time horizons to deliver our pension fund and meet our duties to our beneficiaries, we didn't see the upside of this from our perspective. I can see if you've taken a shorter time horizon, there was sort of potential upside that some people were keen to see. But from our perspective, we didn't feel that having two significant operators consolidating and all the time and energy that was going to consume amongst their management over the coming years to do that effectively was actually going to lead to any additional tons of copper in the world. Equally, when you've got an operator that is very well known for seeking, and they're both operating to good standards, so I'm not trying to say one's better than the other here, but nonetheless, Anglo in particular was a company that I think has walked down the path on what it means to be a socially responsible mining company the most. And I would say removing and sort of in effect gutting that company, particular the position in Africa, was of concern to us when we look at the future and the demand that needs to be met. And actually companies like Anglo, we would think, have got a potentially very significant role, enhanced role, in meeting some of that demand. And the risk that you sort of consolidate the standards element, taking that operator off the table, when actually we need to be seeing much more drive to see standards risen to that level across the industry. We just thought that the case wasn't proven, particularly when you're looking at it through that long-term interest of a pension fund in this instance. So we did make a position in that context. We also think Anglo is a significant operator in South Africa, and that it would have diminished the importance of the role that they play, even with the sort of the rollouts that were proposed in the market in South Africa, where you've got, again, another significant mining environment that needs good practitioners that are of a certain size to be able to play the role that needs to be played over the coming years in the energy transition in South Africa and the future flourishing of the South African mining industry. So those were sort of a multitude of reasons, but it also was indicative of a challenge we've got at the moment where lots of pension funds are so remote from this industry. You've got brilliant people like Tal and George here that are intimately involved in the sector and intimately involved in dialogue with the industry, but a lot of the clients that sit behind fund managers are so remote from the role that we actually need to play as supporting this industry to be able to grow in the most socially responsible, environmentally responsible way, and what in turn that means for us in terms of the mandates we create, the way that we allocate, and actually reverse a lot of the sort of underweighting that we put on this sector. We come at it through a very negative prism when you come at it from the pension fund asset owner perspective, and we've got to completely flip that and double down on the sector, work with the fund managers like the two you've got on stage, find ways in which we can actually inject more into the sector to give it the confidence for boards to be able to meet the global demand that's needed.
Okay, so Jim has a slightly different view on Diversified, that broadly speaking scale. Jim?
I agree completely with Adam that Anglo-American has been at the forefront of a lot of really world-class initiatives around sustainability. And that was particularly given turbocharged with when Mark joined as CEO, and a lot of the initiatives that he pursued, particularly actually one which was very intriguing, the dialogue, the interfaith dialogue with the church, was very impressive. But George, I referred to it earlier, and George hinted at it. This industry has a problem of scale. We have seen all the projections as to what additional amounts of copper, etc., are going to be required to satisfy the needs under the energy transition story. As big as we think that Anglo-American is, it learned a very hard lesson when it developed the Minas-Rio iron ore project in Brazil, which nearly torpedoed its balance sheet below the line when the costs ran ahead of budget quite significantly. So when Anglo came to develop the Quellaveco copper project in Peru, there was a very rigorous discussion took place around what risk could the balance sheet take, and that was a project that had been planned to death. It was very different from Minas-Rio. And the fact is that these companies that may be capable of executing on one project at any point in time, that's where scale in the industry is required. And that's where I would maybe take a different viewpoint from Adam in terms of the potential combination between BHP and Anglo-American. I think the other issue which this industry has not done very well in the past, and George hinted at it as well, look at the comparison with the oil and gas industry, who have developed the joint venture arrangements around developing large, discrete oil and gas projects. The mining industry is really light years behind the oil and gas industry on that front, and that's one area where I think they could actually learn a lot from oil and gas.
Yeah. Also on the tax structures, where, to Rose's point, a lot of the oil companies appear to allow the countries to earn something immediately rather than the very long wait that the mining companies demand.
Yeah, I mean, I'll just follow up on that. I think in today's world, if you as a mining company think that nirvana is basically an agreement that enables you not to pay any tax for 5 or 10 years, you are absolutely, utterly delusional. I think it's absolutely important when you develop a project in a community that tax stability agreements are one thing, but tax-free arrangements, I think, should be off the table. You have to be able to demonstrate that you're delivering returns to the community that you developed that project in and to the federal government. Otherwise, you start to run into problems.
Yeah. So,
Just, sorry,
yes.
to pick up on a point there. I I think a couple of other parallels from the oil and gas industry are interesting to observe and perhaps apply. In terms of diversification, I think geopolitical diversification is an aspect that I personally as an investor really seek. We can diversify by commodity pretty easily, but I think companies that diversify their political risk are more attractive than single risk companies. And the other thing is diversification by income stream. I think there might be scope for mining companies to consider moving through the vertical chain and perhaps getting further into intermediate production in order to diversify within the same commodity, but to access more value through the chain.
Yeah, which we talk about supply chain. So moving on a little bit, taking the conversation into the way sustainability investing has moved in the last few years. I want to be devil's advocate, which is somebody from Harmony Gold is here in the audience, and she said when she went to a conference a year ago, there was nobody in the room for the golds and everybody was there for the forward-facing metals, the transition metals. Well, if you piled into lithium stocks 18 months ago and you would only go green, you would be looking rather sick today. So it's not as simple as that. Tal has moved from a position in his firm where he knows more about the mining sector than I do, but he has now joined the sustainability team because he sees ways of shifting. Tal, how is managing sustainability in mining investing and making money? How are you seeing that?
Yeah, I think there's been a big shift in recent years in the perception of sustainability away from doing everything in a completely clean and green way towards a greater appreciation of transition and the need to accept, particularly as we look at carbon footprints, that in order to facilitate green solutions, we need to accept higher carbon intensity today, and that divestment is perhaps not the answer to the problem. And I think the request that came at me to move the transition funds that I run in the resources sector into our sustainability group marks quite a big shift in mindset that we're seeing perhaps more broadly. I mean, last year there was a 70% increase in fund flow into European transition funds. That number is sort of like $40 billion at the moment and growing, as I think there is a broader perception amongst investors that in order to get to this place the world wants to be, we're going to need a lot of supply chain development along the way, and that perhaps the pursuit of low carbon or green investing has come at a price that doesn't really, there's a gap in that circle that needs to be filled. So we're hopeful that will spread more widely and facilitate the flow of capital into some areas that really, really need it.
So the other aspect to the sustainability, you said moving from disinvestment to engagement, encouraging, still investing in carbon-heavy companies, but working with them. Adam has an interesting perspective as a representative on a UN body, and he is working with engaging with countries, which is a huge understep. Adam, could you just say a little bit about your recent trip to the DRC and what is trying to be achieved?
Yeah, and also just to note how welcome to hear what Tal and Janus are doing, and I also know 91 sort of integrate that kind of thinking in that more holistic sense of we need to be present in this industry as part of the transition solution and understanding that sustainability context. So, but I still think there's lots of barriers in the market against that. But in terms of both Ro and I sit on the UN Secretary General's advisory panel on critical transition minerals, which I think is the right name because it's very long, which is fundamentally a governmental process, and it has been set up about 2 months ago with a view that by September the Secretary General has a position and a set of principles in terms of guiding governments and wider societal adventure in terms of how we approach the need to ensure that the transition doesn't leave a negative, but actually leaves a positive, in particular in mineral-rich countries, particularly in developed and emerging markets. And so the focus of that process is very much underway. It's pretty intense, and we're keen that there is a reflection within that in terms of what it is we need from regulators and governments in terms of the security of policy, tenure, taxation, etc., whilst at the same time acknowledging what it is that the companies can bring to the party in terms of that drive for standards, the consolidation, the commitment to sort of really work in at addressing challenging issues like legacy, and at the same time, what is the finance contribution to that, which is, I think, a sort of a reinforcement of the consolidation, looking at the opportunity for us to potentially invest differently in the sector and the kind of vehicles that could be created. But I also think the partnership that needs to fundamentally flow from this with governments, with companies, with investors, where we're going to need to roll up our sleeves a lot more and look at how are we going to ensure that we've got the kind of partnership in place that a country like DRC is able to ensure that the companies that are going to be extracting and meeting that global demand are seeking to do so with the best standards, but that the country and the people benefit in a way that they haven't from previous experiences. And therefore, what is that greater value share locally and beneficiation? What are the structures that need to be in place to make that a reality? And equally, how do we openly and honestly acknowledge a part of the global supply chain is supplied by artisanal mining and small-scale mining, and we need to find ways to support and work with that reality and that flow into the global system that doesn't try and hide away from it, but actually finds ways in which we can seek good models of formalisation and support, and potentially an economic model that can work better for people as well.
Yes. And George, in terms of if the listed market is not the place for finding new finance for all of these, the supply chain, the juniors, all of that we're looking for, do you see non-public markets able to take up the slack and supply masses of new capital, which is the sovereign wealth funds, the royalty funds, and in particular now governments who are interested in critical minerals? So IRA, US floundering around, throwing vast amounts of money at railway lines and, yes, all sorts of things.
Yeah, the first thing I would say on that is I think we've got to thank the US government, because in many ways they've been the one that's changed the whole perception to some extent. You know, everybody just thought mining was terrible, and now people talk about critical minerals, and in the public you'll hear people talk about critical minerals and basically understand that minerals are critical, which is very basic, but a lot of that US, publicity acts, etc., have heightened awareness to the fact there is a problem and there's a supply chain problem. And I think both Adam and Tao, on the sustainability, we've got a much more mature discussion, I think, about how we provide it, whereas 5 years ago it was just, that's terrible, don't do it. I mean, you couldn't talk about artisanal mining 5 years ago. You'd had the Greenpeace, whatever, report in Congo, child mining, and that was all terrible. And to even say, maybe we need to keep some, it was just like, how dare you? And increasingly people are saying, now, in some ways, many companies just say, well, it's not our problem, we don't do it. And I think that understanding that, well, you're in mining and they're in mining and you're going to be tarnished to some extent by what they do, has actually led to a more mature discussion of people saying, how do we solve this problem? Which I think is all positive. To answer your question about sources of finance, it's a capital-intensive industry and we need all sources of finance, and that includes public listings. I cannot see how you get away from publicly listed companies. I think some of it is partly cyclical. We had the super cycle, we had a really terrible market middle of last decade, and we've still got a bit of a hangover from that. And so people say, listed companies aren't doing well and they're rated badly, etc. Part of that is a perception, quite rightly, it's been a risky place. It hasn't, delivered returns in many cases. But we need it. We do need it. I don't, look at private equity in this space. You can, streaming companies as well. it's great that they're here and they've grown, but they're not enough to finance the industry.
No.
And also, I think, what's ironic in a way is we look to streaming companies, most of them get their funding from the public
current
market.
bank, yes.
If you look at private equity, yes, it's out there, it's taking higher risk bets on junior companies, but it ultimately seeks to exit into public markets.
Yeah.
So we do need to have thriving public markets to facilitate this whole sort of...
Two last quick ones on that. I'll come back to you on, but Tom, you are doing stuff in the unlisted space too to help juniors, aren't you? What's the latest initiative?
That's right. I mean, I think this is not just a mining specific thing. I think this is a broader thing. I think there has been one of the themes of the last 20 years has been the phenomenal meteoric rise of private capital, and so I think in addition to us making sure that our public markets are fit for purpose and are the best they can be, I think we've spent quite a long time in the last couple of years saying, well, actually, your role as a stock exchange pretty fundamentally is you've got people who need capital on one side, people who have it on the other, with something in the middle that makes them trust each other. And actually, if that's your very simplistic view as to what an exchange should do in an ecosystem, why on earth would you limit what you do just to the public markets? Can we do things at earlier stages in companies' life cycles? So this is not just a mining-specific thing, but we've invested in a private platform to allow companies to do genuine private-to-private raises, sort of seed, Series A type transactions, which is going well. And we're also developing what we think will be the first global regulated crossover market, which will launch at the end of this year. The government put out some draft guidelines called Pisces. It's a rather contrived acronym that the government came up with. The Private Intermittent Securities and Capital Exchange System regulation. But
Sounds fishy to me, yes.
So at least I remembered it. I had to do it on my fingers. But essentially what that says is there are companies who do not yet want to be public for whatever reason, but there are some people, earlier stage investors, agitating for liquidity, and this will be a way of taking the pressure valve off that and allowing companies to sort of circulate their registers ahead of a sort of public markets, we hope. So I think you'll hear Julia, our CEO, talk a lot about the sort of funding continuum of going from sort of private through that sort of private to public transition through to public markets and trying to be relevant right the way across that funding continuum. That's where we want to be as an exchange.
Yeah, great. And Jim, you have a direct insight into the Saudi sovereign wealth with your position on the board there. How do you see those sorts of private markets evolving?
Well, look, I think when you look at what Saudi Arabia is trying to do with Manara, in many ways, their model is what the Japanese trading houses did in the 1960s, 70s, and 80s. And they are really trying to replicate that. And if you look through this industry over long periods of time, it was the British that built most of the railroads in South America. Today, it's the Chinese who are building the roads and the railroads. And the Saudi Arabia is kind of it's playing a very similar role to what the Japanese trading houses did in terms of look at their influence over the development of the copper industry, particularly the length and breadth of South America and in Asia. And I don't think we should view it as something new or something different. It's sometimes history rhymes. One point I want to get back on was this issue in sustainability, because this is certainly a subject that's very dear to my heart. I actually personally resent the use of the initials ESG, because with that, a lot of it's kind of like you create a box and it's a box-ticking exercise. As a company, sustainability has to be in the DNA, and it can't be treated as something separate. It has to be in the KPIs for the management team, and they have to live it and breathe it every single day. It's just not some sort of, say, concept that exists in and on its own. And I think what Adam, Tal, and George have pointed to, the discussion around sustainability has really matured to where I think people appreciate it taking a much more holistic view around it rather than sort of, as I say, taking a very simplistic box-ticking approach.
Yeah, and you referred to the fact that you were a late father, an older father, and the implications of learning from your children.
Oh, it's you know more about my personal life than you need to know, but but it was fascinating for me, realizing that today's teenager, when they look at buying a product, a lot of times it has to accord with their sense of values. And that is a little bit of a seismic shift. And I have to say, certainly helped inform some of the discussions we used to have in the Anglo-American boardroom.
Yeah, thanks.
Have you been cancelled at home yet?
Sorry?
Have you been cancelled at home yet?
Yeah. So the final conundrum, which is pretty unrelated to everything we've discussed so far, but it is a conundrum. Why, with the gold price finally soaring, are the gold equities underperforming? So I'm going to have the devil's advocate here first, and then I'll give George, the gold fund manager, the chance to come back on that. Tell, why are the gold equities underperforming the gold price?
Crypto. I think it's taken a big traditional market that would otherwise have looked to gold for a variety of reasons, and it's sucked a lot of money out of potential flow that would have otherwise gone to gold, which is now sitting in cryptocurrencies. There are a number of other aspects from the perspective of gold equities versus the gold price in particular. A sector which, in my opinion, has been overcapitalized, overpaid, and not generated great returns for investors in rising gold price environments. So I think all of those culminate into a skepticism from the average equity investor with regards to gold companies.
George?
Yeah, I think to say it's crypto and then gold trading at a record price seems a bit odd to me. In some ways, the crypto thing has helped gold, I think, in an odd way, in that it's got people thinking about other things you can invest in, which aren't just yield bearing, etc. And I don't see. I think crypto, has clearly taken some money away, sometimes from gold, but I'm not sure it always has. I think the gold price in the equities thing has been particularly bad the last 2.5 years because we've had a cost squeeze in mining, which is not just the gold equities, but across the board. And that's clearly eroded margins despite a higher gold price. I think we're near the end of that. I certainly hope so, but I actually see signs that the latest gold price rise is not being matched by rising costs, and therefore we're going to see margins expanding. But people are wary because they've just been through 2-3 years where they haven't, so they're clearly wary. I think once they see those margins expand, they will come back. I mean, gold companies have had a poor history. I think it was for a number of reasons we can go through. I still think a lot of them are more focused on returns today than they have been for a long while, and therefore, realise they need to improve performance, and I think that will come. So. It's typical, people say this is a terrible industry all the time and they've done this wrong and that wrong and they paid themselves too much, which is true in many cases. But actually, I think in a way we're getting to a point where we're going to see actually a much stronger industry come out of it.
Yeah.
And with some better, more focus on those returns coming through.
Great. So Jim, just on gold, and then I would just like to, because time is starting to run out, ask everybody on the panel to sum up, should people be investing in mining equities given the complexities that the sector faces now. So Jim, just finishing on gold.
Quickly on gold, I'll make 2 points.
Yeah.
First off, in the past, the gold industry has forgotten a basic truism that if the gold price goes up, it helps if your earnings also go up. And there was a great chart which I used to have, which was gold price going up, operating cash flow would follow it, and then as sure as night follows day, the industry capex would also go through the roof and free cash flow would go nowhere. I think the industry's now got a lot more discipline on that front. Second point I would say is that if you look at the chart of the gold prices, basically spent 10 years trying to make a decisive move through $2,000 per ounce. It's made that move, but I'm not sure that people actually regard it as being for real. And if you look at where industry long-term prices are, consensus gold prices are, they do not reflect that new reality of gold trading at $2,300 per ounce.
Yeah, great. So rounding up then, there are so many conundrums facing investing in mining. Just one point on why people should continue to try and get around the struggles, the challenges, and all of that to be investing in mining. Adam?
Well, we don't have a choice but to.
Sorry?
We don't have a choice but to, and to really sort of work with industry, with governments, to really ensure that this sector has the support from its investors that it needs to be able to meet global demand, but also to transition those parts of the sector that are going to need to be managed into a transition away from some of that demand. But equally, I think really embracing some of the agenda that I think Rose set out this morning in terms of the challenges and the way in which the sector can be responsive to that, I think is part of the solution. But I don't think the industry should look at it through the lens that it has to do it by itself. And I think how it can bring in the other actors, these are collective challenges, collective problems, investors, governments, other stakeholders have all got a vested interest in those solutions. And I think sometimes the industry feels it's got to generate its own sort of answers before it then gets out. And I think what Rose put in on the table is offering a route that I think can bring a lot more other people into some of the solutions here. Yeah. And the work of the Global Investor Commission is really looking at the way that investors can play their role in supporting this industry.
Thank you. Tom?
I think a thriving public market is important for the sector. You know, we're trying our best to continue to support that, not just with some of the rule changes, which, by the way, Adam, we're doing and pushing through bodies like CMIT, the Capital Markets Industry Task Force, which Julia chairs, but on which a number of investors sit. Well, we can agree to disagree on it, but you know, very much this is about the ecosystem all pulling together, you know, from all sides to make it a place that works better. Yeah. And I think it's got a fundamental role to play, particularly as we go through this transition. I think Julia often uses the phrase, the transition needs to be televised. What we don't want is public markets working in a way that people decide to delist, to feel they're not working. And I'm not sure that's good for any of us, actually. We need those to have that sort of transparency, visibility.
Accountability.
Exactly.
Yeah. George?
I think it gives you exposure to the transition. I think it gives you a hedge against inflation. I think valuations aren't stretched, and I think it provides diversification for any portfolio. But it is a specialist sector. It's a complicated one and fast moving, and therefore investing in active funds is the way to do it.
Okay. This industry blew its brains out 10 years ago when it went on a capex splurge, the like of which the world had never seen. The industry thought it had got the clear mandate from the investment community to go out and go for growth. But the analogy I would draw is it's a bit like your young kid coming to you and said, "Daddy, can I go to the sweet shop at the end of the road and buy a bar of chocolate?" And 5 hours later, they come back with the entire contents of the shop. And but I think moving forward, I think the industry has learned about investment discipline. Boards still have scars on their back from what happened 10 years ago. And so I think it will move forward in financially a much more disciplined way. Secondly, it needs to pick up on some of the challenges which Rose picked up, is it can't do this alone, and it needs to have a much more proactive focus on its public image. And thirdly, the industry needs to think about more novel ways about it can work together in a more cooperative fashion because companies can't achieve this just operating independently.
Yeah, I think 1 minute, half a minute.
All of the above.
Yes.
I'm reminded of a chart that Stifel's strategist put out, which shows a chart of commodity returns going back to 1796 and shows very long 20 to 40 year cycles in commodity prices. I think we have started one about 3 or 4 years ago, and I think that we've got a multi-decade runway of high commodity prices that will make investing in the mining sector very, very profitable for many people, and that will resolve the issue of capital flowing in. And if we can do it in a sustainable way, then we're on to a winner.
Amen.
Fiona, really, I mean, the audience had to say to you, why don't you go back to that fantastic first point of friction where Adam was agitating that, that there are only downsides to agitating for more relaxed rules, and what is Jim's views on that? So, Jim, this agitating to relax the rules is clearly not going to be good.
I would maybe take a different approach. I think with all these things, it's achieving a balance. I'm a great believer and believe fundamentally in principles of good governance. As an investor, I used to vote against many REM proposals from companies, but I can tell you, in today's world, company secretaries lose years of their lives in the run-up to AGMs. And I think is the regulatory framework fit for purpose? I would say, with where we stand today, certainly in regards to London listings, that the pendulum has maybe swung a bit too far in one direction.
But Tom, you are supposed to be a market maker, but haven't you just become a regulator in disguise? So, I mean, you are clearly in favor of more regulations because you guys just, make more money? I'm exploring this topic of agitating for lower rules, easier to comply.
What we're doing is sort of level setting against the rest of the world and trying to make sure that we don't have a situation where London is competitively disadvantaged by a set of overly complicated rules and regulations that we're trying to, as I say, work with other stakeholders in the ecosystem to reform. It's as simple as that. I think, the listing rules are one piece of that. And by the way, as the LSE, we don't write listing rules. The FCA do. So that's a key thing. It's a bit different from South Africa, where the JSE is judge and jury. We have a separation of church and state there. We have contributed our views into the new rules, but everyone else has as well. And the FCA will come up with its own final set of rules in a few weeks' time. So I think we are broadly in favour of the direction of travel that we're going. And we don't think that, clearly we don't, that investor confidence should be undermined by anything that those rules set, because and that the net result of all that will be a more vibrant market in time, combined with some of the other things we're doing around pushing for reform on pension fund, and ultimately trying to get more risk capital into the market. So you can't just change the rules and expect everything to be fixed, because that's a sort of small supply side issue. You've got lots of other things that I think can and will be done in the next sort of 12 months.
So I want to test with the audience. Let's try and test with the audience the thinking. I'm going to phrase a question that doesn't speak specifically to either anybody's specific point.
Can I just come back before you do? Because I just say, look,
you don't even know what I'm going to ask, and you already want to campaign, Adam. Please carry on. Please.
That's an Indaba, it's a dialogue, isn't it? So,
Go.
Look, we don't have a problem with the reset concept, that there's elements of the current regulatory structures that aren't working in the favour of bringing in more listings and the burden that companies are feeling with the multitude of expectations that are coming at them from every angle. And I don't think the investor community has necessarily been helpful in not consolidating its expectations. So I think there is an open dialogue to be had in looking at how can we get to the optimal solution, rather than the predetermined agenda that seems to be advocated of, it's about watering down. And I think we just need to be careful about what it is that we're about to lose in some of these governance weakenings that are going to occur, versus a more open dialogue, particularly with asset owners as to the role that we potentially could play in greater consolidation, greater focus, and actually ensuring that London really is one of the places in the world where you can get great governance in companies, great supported boards, and you can get the backing and the investment that you need. And I just think we haven't really gone out there with how do we get to that position. We've sort of presumed that a lot of what's been proposed and the watering down is going to deliver some of this, where actually I don't think the case is proven. And 70 trillion odd of global assets have indicated to the FCA that they really would suggest caution at the meeting in 2 weeks' time, post the election, to see what the new government wants and actually open up possibly a bit more space for a more collaborative dialogue.
So
And Indaba.
Adam has now successfully consumed all the time I had for the poll. I was going to challenge you something around the fact that clearly there's a strong correlation between increased regulations and less listed capital. But I said correlation, not causation. It's interesting that the more regulations we have, the harder it seems to be for stock exchanges to deploy risk capital especially. But now we don't going to have time for that poll, so that's not even a worthwhile opinion. I do need to get to the issue of transition, energy transition, future focusing minerals, and yet the industry hasn't or isn't exploring. So can I ask, Tal, can I start with you? Is this a big 20-year animal in the room? The industry is not exploring for the minerals the world is looking for, or not, according to you?
In my humble opinion, there isn't a shortage of minerals. There's a shortage of processing capacity for those minerals. Plenty of lithium around. We're finding lots of copper. Of course, it's getting harder to develop and it requires more capital. And environmental regulation is getting stricter and more stringent. It takes longer. These are all factors to consider. But if we're right about the impending, multi-decade cycle, commodity prices will deliver the ability to generate returns from higher capital burdens, I believe. I don't think there's an exploration issue per se. There's lots of juniors out there finding really interesting projects. I think the problem is more the access to development capital. I think the problem is more the behavior of boards and the point that Jim alluded to around the behavioral change from spending too much, feeling free license to grow, and now the pendulum has swung completely the other way. We're just not seeing enough spending. I'm meeting large mining companies who talk a great game about high copper prices, but are simply not acting to spend money. And I think there is a risk from a reputational perspective that if companies don't start spending money, they will be started to be viewed as rapacious, as not benefiting society, as squeezing the consumer, and in an increasingly populist political environment, that can come back to bite companies pretty badly. So I'd like to see the big mining companies using that cash flow that they have, that lower cost of capital, putting it to work and actually building some growth projects.
Jim, exploration. Are we under-exploring?
There is no lack of exploration going on. One of the biggest bottlenecks in the industry today is actually getting assay samples processed on a timely basis through laboratories. That tells you that there's plenty of exploration taking place. At heart, mining projects are essentially large logistics operations that just happen to have a hole in the ground at the end of them. And where the shortfall has been the timely development of the associated logistics infrastructure alongside mining projects. And that, I think, is what is going to hold things back.
Please, George. This panel started off with the potential to be divergent in views. There's now consensus developing. I hate this. Please tell me there's a shortage, at least in gold. Surely there's a shortage of exploration taking place.
I'm sorry.
Come on, Adam, you're my man now. George.
The one thing I would say is you do see a lot of charts on Capex in mining and exploration, and they talk about it in general terms, and they go back and they look at the super cycle in 2010, and they go, look how much it's come down. If you split it out, a lot of that was iron ore and coal. And if you say we don't need that exploration today for iron ore and certainly not for coal, if you actually, copper probably has a slight problem, but we can discuss that. But I mean, lithium 10 years ago compared to today, it's completely the other way. So, capital's not idiotic. It will flow to areas he thinks there's an opportunity. You see those charts and there's a lot less, but there was masses being spent on iron ore and coal back then. Probably too much.
Until if we don't define refining capacity from a Western perspective, is your statement that that's the problem, is that true, or is it just true because it's all in China and it's not in the West? Is there a shortage of refining capacity in the world or only in the West?
I think it's in the West primarily, and no one wants to be relying on potentially nefarious or unfriendly suppliers of critical commodities. We were reminded of the fragility of these supply chains in COVID. We were then reminded further, with the Ukraine and the supply of gas into Europe. And I feel that that shortage of processing capacity in the West is more the issue than the lack of processing capacity. Now, that means replicating things perhaps, but for strategic reasons, I think that's likely to happen. The problem is that there's a lot of NIMBYism. No one wants that in their backyard. So if we see companies, I think Pilbara Minerals is doing something interesting with lithium. They're sort of going further downstream, looking to beneficiate it, and then ship a beneficiated product to the West for processing. That's quite a smart thing to do.
And that's where Africa can,
Indeed.
And keep more value in country.
I think there's a point there on critical minerals as well. If it's a processing issue, I think countries, when they think about critical minerals, they all go, we've got to develop our own supply chains and we have to do this and that. If actually it's just a processing problem, maybe the thing to do is have a stockpile for 2 years on the basis, if China's sanctioned because they invade Taiwan and you have to build it, you can do that in 2 years. I mean, look what Germany did with regasification. In under a year, they built offshore regasification so they could bring in LNG. When they had to do it, they did it. And I think, as a government, do I need to build all these refineries? No, but I need to be aware that there might be a point I need to do it, and then I need to do it fast.
I have to call tea time. Fiona, panel, thank you very much. Sorry for all the consensus developing through open conversation. This is why I hate open conversation.
What you gonna do?
Thank you very much, Fiona, for a fantastic panel. Thank you.